Welcome to part 4 in our 5-part series on not-for-profit financial statements. I'm Jackie McLaughlin from Chazin and Company. As outsourced accounting professionals, we can help. So let's get started. In this video, we're going to talk about the statement of activities. In the for-profit world, this is known as the income statement or the P&L. Throughout the rest of this video, I'm going to use the terminology P&L since more people are familiar with that. There are two primary financial statements, regardless of whether you're for-profit or not-for-profit. In the not-for-profit world, it's called the Statement of Financial Position, which is the not-for-profit version of the balance sheet, with a little differences we'll go over in the next video. Then there's the Statement of Activities, which is the not-for-profit version of the P&L. The Statement of Activities can be compared to LeBron James' basketball season. So when LeBron plays basketball every season, he accumulates season stats. And that might be something like how many points he put on the board, how many free throws he made, how many assists he had. Regardless of what he's measured on, season stats are accumulated. At the end of a basketball season, those season stats will zero out so that he can start the next season all over again, starting at ground zero. When the current season stats zero out, they get accumulated with his career stats and they become part of his career stats. The P&L is similar to LeBron's season stats. And just like LeBron's season stats or a game LeBron James might play, one bad game does not indicate the whole season will be bad. Likewise, if you have one bad month in your organization, it's not necessarily an indication that the whole year is going to go bad. Also, when LeBron plays a game, afterwards he reviews the footage of the game he played. He's not only looking for what he did wrong so that he can improve, but he's also looking for what he did right so that he can continue to improve on what he did right. In a nonprofit organization or any business, honestly, you have that same ability. Even though it's not film, it's a budget to actual report, sometimes known as a budget variance report. It will allow you to compare your actual progress year to date and track it against how you budgeted. That will allow you to course correct if you find yourself veering way off budget. Here's an example of a budget to actual report in a not-for-profit. You'll notice the farthest left-hand column is titled Without Donor Restrictions, and we're going to cover that in an upcoming slide. The column next to it is with donor restrictions. The third column from the left is the total actual results. That's compared against the budget, and then there's a variance column. Now about halfway down, you'll see under expenses, cost of goods sold, and there's a $4,200 variance. On numbers like this, that $4,200 variance probably isn't worth looking into. On the other hand, at the very top of the slide, you'll see a $2.6 million variance. Those are the types of variances that you'll want to investigate and try to figure out what happened. You've even got some variances in this slide in the hundreds of thousands of dollars, and all of those deserve to be investigated. Not-for-profit differs a little than for-profit in that much of your revenue may come from contributions. When a donor contributes, they oftentimes tell you what they want you to do with their money, and that's called with restrictions. Now, if you have a website and you collect $50, $100 contributions, a donor's probably not telling you what they want you to do with that $50 and $100, so those are contributions without donor restrictions. A donor's not putting any limitations under that. And those are usually the smaller dollar donations. When you get into the larger dollar donations, a lot of donors are going to put restrictions on that. They can be permanently restricted or temporarily restricted. And we'll cover each of those terms starting with perm restricted. Many nonprofit leaders think of perm restricted as endowments, and that is another term that you can use for it. And as an example of perm restricted funds, there is a situation that occurred probably 20 years ago when a particular nonprofit was really looking like it was going to go out of business. And in the community, there was a very high wealth donor. This high wealth donor didn't want the organization to go out of business and gave them $55 million, but said, you can never touch this money, ever. Now, when I tell this story, a lot of people look at me quizzically when I tell them that this organization got $55 million that they can't touch, because they think, well, if the organization can't touch the money, how is that going to guarantee that they don't go out of business? And it happens because that money earns interest, dividends, capital gains. It has market yields on it. If the market was performing at an average of 10%, that would be $5.5 million that donation would give off in market returns every year. In this particular case, the donor told the organization they could use the returns for whatever they wanted to. In other words, they could pay the rent, keep the lights on, pay any salaries they wanted. Most of the time, the donor will restrict those earnings and say, yes, you can use the earnings, but I want you to use it to build a bell tower or whatever pet project that donor might have. When the donor restricts the use of the earnings, that's called temporarily restricted. So unlike permanently restricted money, temporarily restricted money can be spent, but it's very limited on what it can be spent on. Temporarily restricted money can also come from contributions that are in no way tied up with permanently restricted contributions. Oftentimes, your gift department or fundraising or advancement development, whatever you call that department, oftentimes it will go out and raise money for particular purposes. Maybe it's to start a baseball program. When donors give money to help start a baseball program, that's temporarily restricted money. You can use it, but only for costs that are related to starting a baseball program. In the without restriction category, you have a couple of subsections. There's just plain old unrestricted. And again, that's a typical example of when you have a website and you got these small $50 to $100 donations that you can do anything with. A subsection of without restrictions, though, is called board designated. And notice the word designated is different from the word restrictions. Only donors can restrict. Boards can designate. And this happens when an organization has enough of a surplus that a board looks at the financials and says, let's designate some money for a rainy day or for whatever purpose they might want to designate the money. Maybe the entity is going to need a new roof and the board says, let's put some money aside to save towards that new roof. The key with board designated funds is that because a board designates the money, a board can also undesignate the money. So maybe you're having a year and you're doing really well and the board designates money for that new roof. Maybe next year you haven't started construction on that new roof yet, but cash flow is getting a little thin. The board can also say, never mind the roof money, let's undesignate that money and put it back into unrestricted cash to pay the bills. If possible, it's always a good idea to spend restricted money first, but only if it's being spent on the restricted purpose. Oftentimes, nonprofits don't like to spend this restricted money because they look at it as savings. But because a donor has restricted this, if you're spending money on the restricted purpose, it's always best to use the money that a donor restricted. If you want to save money, you can always have the board designate certain amounts in the board designated funds. But the best practice is when you're spending money, if you have donor restricted funds that are restricted for that purpose you're spending the money on, use that first. So back to my baseball example, if you're building a baseball program and you're sodding the field, you're buying bases and bats and uniforms, and you have donors who've given money for a baseball program, use that money first before you spend your unrestricted funds. But again, only spend restricted money on the purpose for which the donor has restricted it. Never, ever, ever spend restricted money on unrestricted or operating purposes, ever. It can get you into a lot of trouble with the donors and potentially the IRS, so you don't want to do that. As a nonprofit, there will be a couple of external parties you may have to deal with. The top of the slide is the IRS. You definitely will have to deal with them. Even though you're not required to pay income taxes, you are required to file an annual tax return. It's called an I-90, and it's largely informational in nature. The 990 is a matter of public record, and it's uploaded to a number of websites out there. So donors or grantors may go there to read your 990 before they contribute any money or give you a grant. You may be required to have annual audits. This will be mandated by your state's charitable solicitation license. Each state has requirements for you to obtain that license, and depending on your revenue, that licensing may require nothing or a review by an independent CPA, which is far less in scope than an audit, or it may require a full-blown audit. So I encourage you to look for your state's charitable solicitation license rules to figure out if you'll need an audit, a review, or possibly nothing at all. That concludes part 4 in our 5-part series on not-for-profit financial statements. See you in the next video on the balance sheet.